Have you guys been denied on your CMHC construction application? Well, Josh and I are going to sit down today and talk about some of the alternative options you might have to move forward with your development. So stay tuned. Hey guys, Aaron and Josh here at the Findlay Mortgage team, and today we want to talk to you about what happens when your project cannot qualify for CMHC construction and what other alternative options are there out there for you.
Yeah, so historically there have been a ton of options for construction financing, but recently over the last, let's say 12 to 18 months, as capital constraints have hit all lending, the amount of options available for smaller construction projects has drastically dried up. Usually or historically, if the bank didn't finance you, you could go to a mortgage investment corporation. Now what's happening is the banks are being very selective about who they're actually allowing to have construction debt. So what's happening is it's cascading down. So borrowers who were once bank borrowers, these bank borrowers are getting pushed into the private financing options. Now these private financing options have capital allocated, but they're not necessarily allocating capital to these borrowers who are subprime or who don't have as much experience because they have a ton of A borrowers now. So what happens in a situation like this when borrowers are looking for smaller construction loans in a market where liquidity is dry?
Yeah, when we're taking a look at construction loans, 99% of the lenders out there for CMHC construction loans want that loan to be around like 10 million. So obviously when we're talking about 5-unit like municipal developments in GTA or some of these smaller projects where you're anywhere from like $1 million to $8 million, chances are you're not going to get financing with these big guys. Now there are a select handful of smaller lenders out there that will take a look at these $1 million and up loans, but it's not guaranteed that the financing is there. CMHC capital allocation for these projects, it's not as large as some of these bigger lenders that have billions of dollars to throw out. So, halfway through the year, this allocation, it really does start to dry up. And, what happens as you're moving forwards? Or, what happens if you want to do a self-build and you're not qualified enough to be able to qualify for CMHC, or maybe you don't have the capital requirement. There's quite a few different scenarios where, you may not qualify or your project may not qualify for CMHC. And we just want you to let you know that there are other options out there. First thing starting with could be, a credit union or some sort of like A-type lender that allows for these smaller builds. Obviously on these A-type projects, you're going to get, better rates than you might get on your semi-private or your private lenders. But the big issue here is how they underwrite the loan and what they're looking at the takeout versus how you want to be looking at a takeout. If you go to a credit union and you're looking to build a project, they're underwriting your loan based off of how that credit union would take you out. So they're taking a look at using, 7.5% interest rate, give or take, with a 25-year AM. Obviously a lot more expensive debt than what you would be getting if you were using, a CMHC loan. This means that even though you get slightly better interest rate and lower fees, the amount of loan that you're going to be able to qualify is going to be substantially less than what you'd be qualifying with on a CMHC loan or some of these mortgage investment companies that are doing their private financing options.
Yeah, and what we're seeing is there's kind of a disconnect between the borrower's expectations versus what they actually are able to achieve. So if you want the absolute best rate in the market, you want the ability to be able to pay the absolute lowest fees available, well, the amount of capital required or equity injected in your project is going to be significantly higher because, as Aaron said, construction debt is all maxed based off of the operations of the building or the pro forma at the back end of your project. So if you're using lower amortization, lower loan to value options in the back end, your construction loan is going to be limited by that, which is going to require you to have more capital in. And in today's, kind of investment situation, we're seeing capital constraints being a major issue. So just getting your expectations in line with how much capital you have and how much capital you want to inject in the project versus what it's going to cost you, that conventional option might not be the best option for you depending on what you're actually looking for in the back end of your project.
And a lower loan to value or loan to cost on your construction proponent doesn't mean that you can't get that 85 or maybe 90% loan to value takeout on the refinance, again, because you're doing new construction, specifically here. It doesn't really matter who you're building with, you can still exit out, but it's going to be the amount of capital required getting into it, like Josh mentioned. So it doesn't necessarily impact your refinance, but it's how much capital they need down front. Taking a look at option number 2, We have our mortgage investment companies, slightly higher because they are semi-private, private lenders. So you're going to be somewhere between, maybe you get lucky, you're 10, but you're about 10 to 12% on the construction, depending on who you go to, plus you're going to have your fees. The bonus with these guys is they're a lot more flexible with their underwriting and how they look at the project moving forwards. Unlike the A lenders that are underwriting your loan to cost and your loan to value based off of their own exit, these guys understand that we're exiting into CMHC. So if we put together the pro forma and we show them, hey, we're going to be 85, 90, 95% loan to value on the exit, and they underwrite it and they understand, we're going to be able to get that higher loan to value, loan to cost on your actual construction project. A lot of these guys will do up to 85, 90% loan to cost, or maybe they're basing it off of a loan to value, depending on how many units you're building. So, a lot more flexible, a lot more understanding, but a little bit more expensive debt. But, that's what you get when you're looking to get into these creative situations.
Yeah, so predominantly these mortgage investment corporations are using like 65% of the as complete value in available capital to your project, which if you cross-reference between the conventional option versus your private option, it's a significantly amount less capital to be put in your project, but you do have a higher carrying cost. Now keep in mind when you're doing a construction project, you have a 10% holdback. There's no carrying cost on the debt as you're running through your project, but the 10% holdback and taking your draws does also take up capital or have to allocate capital to your project. So the more capital you can have allocated to your project from the lender, the less capital you're going to have injected. And when you're looking to do construction, remember, it's all speed. How fast can you finish the project? Because if there's a difference between 6 months in closing with a MIC versus closing with a conventional lender, the name of the game is speed. And if you can get it done faster, you're going to be more profitable. It's just understanding how to move in and out of different types of capital and the advantages and disadvantages of each. It most definitely is more expensive to take on a mortgage investment corporation, but if you take a look at the cost-benefit analysis of speed, time, red tape, and overall cost, it might make sense to go with that option.
Yeah, creative draw structures. There's a lot more flexibility that we can get with these private guys than what we're going to be able to get with an institution. Now, a few of the reasons why you might be struggling to get your CMHC debt, obviously loan size is going to be one of them. Like we said, you should really be about $10 million loan, not necessarily budget, but also maybe experience. Like who are you looking to build? Are you doing self-builds? Do you just not have the experience, or maybe you haven't built this particular type of unit? If you are a developer and you have a lot of experience with townhome developments and you built hundreds of townhomes, but now you're looking to build a 7-story building, you don't have that experience there, right? So the lender's going to take a look at that and they're going to want someone to have that experience. So maybe you can't get into an A guy and CMHC doesn't want to lend to you, but maybe you have a mortgage investment company that's okay with you having that because maybe you have a GC that's experienced or someone that's going to be able to come on and help make up for that lack of experience. Especially when we're looking at taller apartment buildings and you start to get into concrete, lenders, specifically CMHC, they're really going to want you to have someone that has a substantial amount of experience building with concrete. Concrete is such a difficult and intricate process. If you've never built with concrete before, you're not going to be able to get that, AAA type CMHC financing. Again, that's where we're going to be able to use these private guys to be able to come in and they're going to be a little bit more lenient maybe on the project. Capital, like Josh said as well too, you don't have 20% capex to be able to put towards your project, and if you're doing maybe land acquisition, you don't have the down payment, whatever the issue is, if you just don't have enough capital, it's gonna be really tough to qualify on these A guys. They like you to have the capital expenditure. Coming into the private side, again, they can give you a little bit more on that loan to cost or on that loan to value and make up for that upfront cost needed. It's going to make it a little bit easier for you to get into. Obviously, we don't recommend going into a construction project with 5%, especially in today, cost to build, it is coming down a little bit, but construction projects, there's so many unknowns. You can get into it. You can't predict what's going to happen 12 months down the road, cost, inflation, time, layoff, who knows, right? Like maybe there's some hiccups that come up in the project. Maybe you underestimated your cost values. Again, just because there's these projects and these products out there that, flash 95, 90% loan to value, doesn't mean you should be walking into a construction project with a 5% down and expect to get it done. Part of you being an accredited investor and an accredited developer and a realistic investor is having the money to get these things done and understanding that you need capital to get this done. You need capex. You need that that reserve capital, or else you're putting yourself in a situation to go into bankruptcy. And we're seeing it all the time right now. Big name developers, big name guys, worth hundreds of millions, billions of dollars that have projects falling apart. So you as an investor that's worth a few million, it's great, but you got to understand a bank they're comparing you to the big guys. And when the big guys are falling through, they don't hold that much faith on the smaller net worth guys.
I think Aaron has a really good point when he brought up with the 95% loan to cost situation. Again, it's a buzzword. It's this really flashy, great number that a lot of investors think that they just need 5% of the total bill to make this happen. Realistically, guys, that is not the case. So 95% loan to cost is the maximum financing you can achieve on the back end of your project when it's complete and recouping the cost for your construction loan. It doesn't mean you need 5% down to actually complete the project. Construction loans are based off of a cost to complete basis, meaning capital is injected and then it is given back to you as you complete the project. So again, when Aaron and I are sitting down with our clients and we're discussing how much capital do I need for a construction project, 25% at least. You have to have the foundation in the ground, the footings in the ground, possibly some of the walls up. A lot of the lenders right now don't want to see any debt on the dirt. Having the ability to be able to have very low leverage at the start is the most important aspect when you're looking to shop for a construction loan. If anybody has gone shopping for construction financing recently, you'll know that borrower covenant has become a massive requirement for even the private lenders. Understanding that they're probably seeing the majority of their defaults on construction debt. What happened was when rates started to go up, again, as we said, you're financed based off the back end of your project. So when rates start to go up and the bank starts to recalibrate your back end loan based off of rates increasing, the amount of capital required to inject in your project, some of these lenders had capital calls to these construction borrowers and they didn't have the money. So they're stuck with these half-done project with millions of dollars they can't inject into the project. And they're fighting right now and trying to figure out how to get these projects complete. So when your lender asks you for proof of capital or proof of liquidity, your strength, your past experience, your strength of overall borrower, these are things that are imperative for the success of your project in today's market because capital is tight and credit is tight right now. So if you're looking to get into a project for your first time, just understand that having like a guarantor, having a GC, or having a team around you who has the experience needed to do this is going to be the most important part in being able to have a successful project.
Yeah, and following up on that, as a new developer, you might have to give up the equity in your project for the first year. It's more about building your experience and building that CV than it is about making money on your first few projects. Can you go out and get completely private debt and make it work? Sure. The risk there is, it's quite high and it's going to be quite expensive, but to be able to go in and get a debt or, better financing, cheaper financing, and get that experience and get it under your belt and, do a few projects, then be able to go in low with the lender and do it on your own. Like that's honestly probably more important than about just trying to make as much money as you can on your first few projects. Obviously, it's got to be worth it and there's margins there that you got to consider. But again, as a developer, you got to be thinking long term, not just, hey, let me just make a quick buck on a few projects and I'm going to, hit the road and be in retirement. You're building yourself. You're building an experience, a resume, a CV. You're building that relationship with your lenders. You're putting that together to be able to show CMHC your portfolio. So there's a much bigger picture when you're getting into the development than just looking to make money really quickly on a few projects.
Yeah, I have a saying I tell most of my construction investors. It is, nothing happens as fast as you wanted it to or as cheap as you thought it would be. So if you are looking to get into a project, it's probably going to take you longer than you thought. And it's going to cost you more than you anticipated. So when you're looking to get into a project, construction is the most capital intensive thing you could possibly do as an active investment. And banks know it and borrowers are starting to figure it out pretty quick. So setting and aligning your expectations with what's available on the market right now, it's a phenomenal way to be able to grow multifamily assets. There's a lot of money being thrown at it from the federal government right now. CMHC and understanding your products that are available in the market is a great way to start, or a great place to start if you're looking to get into this. But do you have any questions about setting expectations or how much capital you actually need to be able to do a project? Aaron and myself are always available to chat in regards to what you need and how we can set up your financing debt structure to ensure that the project is going to be a success. All right, guys, if you guys enjoyed this video today, please hit the subscribe button, hit the like button. It allows Aaron and myself to be able to create more content like this for you. If you have any ideas about any specific videos that you're looking for us to create, leave it in the comment section below. We'd love to be able to create more content geared towards what you guys want. So again, really appreciate you watching today. We'll see you on the next one.